Okay, so here's the second part to chapter 4. Up until now, we recorded all revenue and expenses into the company's capital account. For example, if we had sales of 500, we would increase the cash and we would increase the capital. Doing this does not show clearly what caused the change in capital. We want to be more specific in our accounting records. So we're going to make two new accounts. One is called revenue and one is called expenses. So if you look here, the red T chart there shows the owner's capital. And you also notice on the right-hand side that it has a normal a normal credit balance. Now, do you agree that when your company has a revenue, it's increasing your credit balance? So to increase your capital, I have to put on the right-hand side. So that is why I put capital or revenue on the right-hand side. If your company has expenses, it has to bring down your credit or your capital. So it has to go on the left-hand side, and that is why I put the T chart for expenses on the left-hand side. So those two things are really important. Okay, so I want to show you something. You received cash from daily sales, $300. Cash has a normal debit balance, so you see the stars there. Your cash is going up, so it has to be on the left-hand side for $300. Now, instead of using capital, we're going to use sales. Sales increases your capital, so it has to be on the right-hand side. And it's increasing by $300, so I have to put the $300 on the right-hand side. Okay, pay cash for telephone bill. It deals with cash, and then any kind of bill, like the telephone, the power, the water, that all is going to be grouped into one expense account, and we're going to call that utilities expense. Cash has a normal debit balance, and your cash is going down $25, so I put on the opposite side. We already talked that expense accounts bring down your capital. So to bring down the capital, it has to have a normal debit balance. Every time you are paying a bill, your expense account is increasing. Think of it as like a basket. You have an expense account basket. Every time you pay a bill, you put that bill into the basket is getting more filled. So you need to you're increasing that basket. So we have to put the $25 on the left-hand side. Sometimes people get confused between liabilities and expenses because you're paying them. When you pay a liability off, you're decreasing it. You owe those people less money. But when you're paying a utilities expense or any other kind of expense, think of it as the basket's getting more filled. So it's actually increasing. Paid cash for July rent. That, of course, deals with cash. Rent's going to have its own expense. We're going to call that rent expense. So cash has a normal debit balance. It's being decreased by $400. Rent expense. All expense accounts have debit balances. You're paying that rent expense. You're putting it in the basket. It's getting more filled, so it's increasing by $400. Paid cash for broken windows. Of course, we're dealing with cash. Broken windows don't happen all that often, so you would put that into something called miscellaneous expense. So anything that doesn't really happen often. Cash has a normal debit balance. It's going down. I didn't put the amount, so let's put $100. Cash is going down $100. The miscellaneous expense basket is getting more filled, so $100 has to go on that side. Paid cash for repairs to seed spreader. Now this is referring back to the Lawn Master company, so you kind of have to know what company you're dealing with, and a seed spreader would be something called equipment. So you would say equipment repair expense. So anytime you're fixing something that you need to do business. Cash has a normal debit balance. and so does equipment repair. Your cash is going down $25. The equipment repair expense basket is getting more filled, so it's being increased. Okay, so you'll see here you drill 4D2 and problem 4.1, just practices the stuff that we've already talked about.